Welcome to Sprague's Market Brief. It's February 1st, 2012. This is Taylor Hudson, joined by Hugh McNaughton. Hugh, it's been an interesting few days since we last did our daily analysis. Prices have generally moved higher, but recently we've seen some big up moves not hold into the close. What's going on?
Well, Taylor, you're going to have some more graphic evidence, and there's a clever pun coming here because the graphs are going to be in the form of graphs, charts, to support maybe a case here that while we're focused on the recent development of some longer-term factors that dictate that prices going through 2012 are more likely to hold rather than fade, and especially fade in any dramatic way. There certainly is some evidence at the present time that the rally that's been with us since mid-December, that took us from sub 290 heating oil and gasoline down below 260, all the way up to where we currently are, maybe running out of steam. And I think the reason could be, or what could be a possible explanation here, is there were two main reasons for the rally to start off with. One was the geopolitical factor with Iran, of course, and the Strait of Hormuz and all that good dramatic stuff. And then more recently, the deteriorating situation in Iraq. Those geopolitical issues haven't gone away, but they certainly, without a further serious development along those lines, it's hard to see how much more of a fair factor, as in a perceived threat, could be priced into the market without something more dramatic. The second reason for the month-long rally here has been these improving indications of, on the economic front, a possible resolution of the Eurozone debt crisis, and significantly better economic indicators coming out of the U.S., indicating that if U.S. economic growth is not assured, then it's certainly looking better than it did a month or so ago. However, speaking of the lack of assurance, the last couple of days we've seen some disappointing news on the November housing, and a real downturn in the December consumer confidence, as important as that is. And both of those might indicate that what we've got here is a market bottom line that's receptive, or at least vulnerable to a pullback from current levels.
So you're telling me that maybe the economy isn't as good as people think it might be?
Maybe not in the short term. It may be that longer term, the Fed's increase in liquidity and other indicators, other indications rather, will continue to pull us out of the slump that obviously we have been in. But it's clearly we're not rushing towards full employment anytime soon here.
I'm shocked. Thanks very much, Hugh. Appreciate that. Let's move into the charts real quick and try to wrap this up. For the chart folks, we've had an interesting few days since we last did a brief. You're looking right now at the 2-oil chart. We last did an update on the 24th of January. Heating oil was trading just under 305, 304-ish. We actually moved higher over the moving averages in conjunction with a breakout in gasoline that you're going to see soon. The last couple of days, we've seen heating oil really try to make a move higher and just not hold. And that's actually, if you could see the pointer here, the last two candlesticks I show on this chart. You can see the very skinny black line on the top. That's the range of the market during the day. And then the red bodies of the candlestick actually indicate that the market closed lower on the day and towards the bottom of the trading range. So we've had 2 days now where the market has tried to make a run at that January 12th high of 313.64. It's failed, and it's pulled back into, as of today, some moving average support. Oh, I made a mistake on my chart. It should say moving average support instead of resistance. I apologize. Basically, this chart is going to continue to look bullish as long as the market can stay above these moving averages. But what the bears are going to hope for, and I think I dare say what most heating oil dealers may hope for, or end users, is that the market can get established below these moving averages and quickly see some pile-on selling. So if that's the case, if we do get some pile-on selling, then you really don't have any serious support on the chart until you go back to mid-January, probably the 299 level, or you see the 40-day moving average sitting out here at 297.70. That would act as major support for heating oil. If we move along now to the gasoline chart, this is the one that's really been the most bullish since we last spoke. My arrow here shows the last brief was done on January 24th, and just the next day, on the 25th, the market was able to go up and break the high set on the 18th of January at 285.58. It didn't settle there, but it broke the high, and that allowed for a continuation the next couple of days to work higher, set new highs, and then last Friday, we had that explosive 11-cent move when we got the Bayway refinery news. The market hit a intraday high of 297, and since then, we've sort of been in the middle of Friday's trading range. Today, we had some chart action that was similar to what we've seen in 2 oil. Gasoline really tried to get up there. We actually saw some midday price moves higher by wholesale suppliers. We traded as high as 295. As of the time this chart was taken, the market was trading at 288, so a 7-cent move lower. For gasoline, this chart is going to continue to be bullish until those moving averages are at least challenged. Now, for the bears, they could easily be challenged, and that could mean a big day down. You can see the first level of support is actually not until the 9-day moving average at 285. So we could have a almost 4-cent move lower in the markets, let's say tomorrow, and we still wouldn't be violating that 9-day moving average level at 285. Beyond that, if we got some pile-on selling, boy, we could really see some much lower levels. But charts are funny. Until the market moves there, then nobody's going to be a believer. Finally, let's move on to crude oil. Crude oil is important because this is the chart that for the bears in the crowd, we need to break down, and it has the best shot over the short term of doing so. We last spoke when crude was right in the thick of its moving averages, right around $99 or so. Crude did not follow gasoline higher, did not follow heating oil higher, and instead has had several days where it's tried to extend higher and failed. Yesterday was a great example. We got up over $101 on the March print, came all the way down and settled in the 98.90 level. Today, the market tried again to get up above those moving averages. It couldn't do it. It failed, and as a result, the bears pushed this market right down to the low that we've seen on January 23rd at 97.40. This thing's on the cusp of being broken, and I think all the bears will be gunning for this one. If they can get this level to break, the 97.40 number, then you really don't have any support on the chart until right down here, the December 16th low at 92.52. That would be great news for all the end users in the crowd and folks who are looking for lower pricing. But we have to wait and see if it can happen. So with that, we again thank you for your time today, and we welcome your feedback. Thank you very much.